Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, August 30th, 2023. It is 10:19 a.m. Eastern Times. I'm starting the video. Really wanted to get this one out. This is one of those days that I think has a lot of potential. Big day, in my opinion, because it has the potential. Again, we may get a non-event. We may close right on these levels I'm about to highlight, but this one has the potential to kind of make or break that whole my alternative scenario of a marginal new high, which is still just that, alternative, not my primary. My primary long got in a little early here on the bounce, a day or two early, but figured this is that was my right here, that max bounce target, that downtrend line, and that roughly 373-ish level right there. Again, QQQ is a hair above the horizontal price resistance, but not really. If you look at it here, you can see some support right here on these candles that are a little bit above. It's more of a zone. I think I had a zone on the 60-minute. But most importantly is that downtrend line. And not just that. It would never be one thing. So let me just reiterate. Like I said, if we continue on, I'll make, the euro is the one thing kind of dampening my convictions on the case that we're not going to go on and make those new highs. But with that being said, a trading plan is a trading plan. I'm sticking to that. So I mentioned yesterday shorting that trend line, added some shorts today because the market's open now. I'm seeing Apple hit that maximum price target. So let me just run through everything, and I'll loop in a few more things. Somebody asked me just now about wheat, and I wanted to update that as well. So again, just to reiterate, there it is. Bounce target hit. That was the bounce target from... I just pulled up. This is going back to at least August 17th right here. Preferred scenario, these yellow arrows going up there, hitting that level and then reversing, as well as that Apple trade. Apple carrying up there to that T2 level. We say sell hair shy of the resistance level you're actually targeting. What did I have that as? Whatever. Let's just go to the updated chart. Apple 60-minute. You can see it here on the daily too. Remember, I went over these yesterday. Here's that 28, or no, the 50. That's the purple line's of 50, and there's the yellow lines in there as well. That's the 50 exponential and simple right there. And it's a big old gap. So in the post I got out to you today, use this board here. That's my bounce target one. That's where we grabbed it as post as a trade idea, bouncing up to here. And what I gave you today is a maximum target up here because there's a gap. The way it works is gaps once entered are often backfilled. And there's technically the very top of the gap. I had set that price target a hair below. So that's it. Anyways, I put good odds at the very least of reaction here. So again, you have to define your trading style, where you think things are going. And I'll say this too: if you don't know, I know I can tell from the comments I make people's heads spin. Sometimes there's actual outright anger if I cover a short and then I'm turning around long, and I'm saying these were all the targets all along, these short targets. And that's just how it works. I don't want to ever short a stock if I think it's going from here to here, but I think it's going to do this in between. If I can, get out of that short, turn around, and then even profit from the long, if I'm targeting a 20% drop in a stock, I can turn around and make 30-40% on that trade by sidestepping the givebacks and turning around and making those profitable. And it doesn't always happen, and sometimes you get shaken out of the trade because the bounce never comes. But anyway, that's it. So that Apple, this is the big dog. We can go over them all, but Apple's the big dog, and that is now at a pretty significant resistance, and along with QQQ. So that's how it works. All right, so I don't want to beat a dead horse. That's it. If it goes up now, the one thing again, giving me pause. I've been covering the euro forever and a day, talking about these divergences. It kept building, and the euro just couldn't get any traction. Now, again, it's not as if they haven't played out. Every divergent low, this was a divergent low. This is your first divergent line. You can see it here, divergence line. And let me pick that up. What's moved here? Something's moved over here. Okay, that was your previous divergent low right there. breakout, divergent high, bearish. And so this one's been just a series, when you have divergence, unless the previous lows are taken out. This is where we started diverging right here on the PPO from this point. And so there it is. And now this rally, and again, I've covered this a lot, especially recently. The unmistakable correlation, positive correlation between this, the euro, US dollar, forex pair, and both gold, silver, GDX, and the stock market too. So again, it's no surprise, should not be a surprise at all. And look, you had a little, looks like a bull flag if you zoom in closely, and that's pretty much met its measured target. You had this impulsive move up, you broke out of this downtrend line, little flagging action right there, and pretty much if you look at the flagpole there, your flag, you've pretty much met the measured target. So this, again, to me, it's a matter of we're just going to have a little pullback, and that's why I'm doing this video. That's why I fired off the Apple and the QQQ, at resistance this morning. At the very least, you can book profits if you took the longs, or active trader try to game a pullback, or hey, if you think we're going to new highs. And let me tell you something: if this divergence, the scope of this divergence would indicate more in a vacuum, at least. Looking at this is a 2-hour chart. I'm on a 2-hour time frame. There it is on the 60-minute chart right there. But when I look at the daily now, remember this is bigger picture on euro, guys. We had this uptrend line, and it's a pretty clean one. We had big divergence right there, negative divergence. We broke down. We hit this support level the other day, 107,633. I've had that line there since April of 2022. But look where we have. I've had this line here since April of 2023, April 3rd, as former support. Once broken, a lot of reactions on it. It was support there. You had reactions there, a false breakout. They tried to break it, failed, and that was, I always say, one of the most bearish things in investing and trading or technical analysis is a failed breakout. So that's why you had a pretty hard rejection. Broke above it there, went in a trading range, but couldn't hold it. Broke down again, hard sell. Again, it's tried to get through there, so it's not a hard level. A hard level is what I would call a resistance level that has no violations. This is one that the euro keeps trying to pop, and it's below it. So anyways, it's a level. It's a level. Call it what you want. Not a 10 on a 1 to 10, but it's a resistance level. So there's cross currents here. On the bullish side, we just broke that downtrend line. That's on the daily chart here. But we rallied to resistance. We're coming off oversold readings. So it wasn't surprising. That's why I've been looking for the bounce in the euro, and likewise the bounce in the stock market and gold and silver and all that stuff. But the $1 million question would be, is it over? When I look at the weekly chart, this is a big, old, fat, bearish rising wedge pattern right here on the euro-US dollar pair. Lots of reactions along it, and it just only recently broke down. So this is going to indicate more downside. Probably to at least this level here. And now, so again, because I know it's confusing, I try to compartmentalize my outlooks between short term, intermediate term, and long term. And sometimes I'll even say near term or very short term. In this one, what I think will happen is intermediate term more downside, and longer term more upside to this downtrend line here. And so this is when I'll, if we get down there, and if the charts confirm, that's when I'll be looking, or maybe all the way down here, to buy gold, silver again, and equities. Now look, let me just say this. Let me go back here. If this divergence continues to play out, we've only just broken out of that downtrend line. And again, I had it drawn a little different on the daily. That's the trend line I had on the daily right here. So let's use this one as well. That comes in a nice, clean 3 reactions. One off the highs, a distinct reaction there, and recently. So by that measure, and I know I have a lot of lines here. Here's the salient lines: the primary downtrend line, the divergence line. And so that gives us this almost a wedge type, almost a contracting channel pattern. But that would indicate a lot higher. If this happens, and I have to tell you, the odds are decent. I wish I didn't see this. I'd get a lot more bearish and aggressively short now. Because if this plays out, it's going to take the market most likely to retest and probably punch through those previous highs. And If that happens, I'll just tell you now, my God, that the cheerleading squad they're going to bring out on CNBC, you won't have seen the likes of it if we take out these highs right here. And that'll probably be a great blow off top type scenario. Bullishness should hit extremes. We'll probably see the put to call ratios and all that stuff fire off some pretty good sell signals. So I'm still very open to it. And look, it's not much. We're talking, if I tried to guesstimate it, because you can't call a top, there's no resistance above that point. So you have to look at the 15 and 60-minute charts. But we're talking probably about anywhere from 4 to 6% from where we're at right now. So again, the takeaway is, let's see how we end today. They're going to step in. They've already actually stepped in a little and at those resistance levels. Here's a 1-minute chart. So we hit resistance, the trend line I told you here on QQQ. You can see the reaction so far. Whether there's going to be more to that reaction or not, we'll see. And that's why I guess the one takeaway is you can sit back if you don't know what to do. Wait until today's over. If we park here today, it's not going to tell us a whole lot. If we get a pretty impulsive rejection here, that will say, okay, there's a valid level. And again, it's what I told you this morning. It's what I said yesterday. You can short here at resistance with a stop somewhat above. For a week now, I've been saying that's my no-go zone. That's where I'm no more shorts there, and I'd rather be long than short. And likewise, you can wait for a pop above that level. That would be a breakout. And that's going to increase the chances that we're going to go out and run at those previous highs and, again, probably take them out. So it's a simple thing, almost a binary level, long here, short, short under that line, long above it, or at least, start to scale out. That would be, I think, prudent if you are short. And you can always get back in if something funky happens, like a false breakout, and we do that. And again, if you're bullish, you can, if you, started laying out, a case for longs back here, and you can keep trailing those stops up. You got to give it a little bit of room because they're probably going to have I would guess at least a little bit more of a reaction off the that hit of that trend line right there. So far, it's only been a drop of about 0.85%, so less than 1%. And remember, Apple also coming in and hitting that resistance right there. So that's it. So we'll watch and we'll see. And if Apple can power on through here, especially take out, backfill the gap, and then some, that's the last. Other than the previous highs, that's it. The top of the gap is the last resistance that I have on this chart. That after that, then you have the previous highs right there. You had Apple up here, right, around earnings, and the divergent high and the breakdown and the back test. And at the end of the day, this breakdown was a pretty good move down. Did it satisfy the measured target? Yes. If you look at a bearish rising wedge and you take the widest part of the wedge, which would be from here to here, on the way to do it, and you take a trend line, draw a trend line there on the chart, and then just pick up that trend line or duplicate it and move it. So by all accounts, Apple met the measured target. In fact, that was my first target there, was at 176.15. Second one was here, and we came very close to that second target. So maybe that's it, and Apple's just going to continue its great bull run, but maybe not. And again, we have a lot of resistance levels. So that's it. I think it's a very one of the most important technical junctures I've seen in a while. I'm a flexible trader. I have no problem covering, reversing short to long, long to short, and hopefully the market's going to give us an idea in the next day or two as to how this level is going to be resolved with both Apple and everything else. And remember, there's the top of the gap. That's really the max bounce. Anything much above that, it's just probably going to run at and take out those previous highs, is my guess. Okay, so again, the euro has been it was the same divergences in the euro, and we had the positive divergences on gold, silver. Got those out to here. Gold's hit that. That was my second initial swing target, and I still had and have those potential additional targets. It just now the RR is not nearly as good as it was back here. This is when it's my style. Nobody wants to buy gold when it's here at a multi-month low, but that's when I like to buy gold. That's when I bought Apple and everything else when it was just at the recent lows. But now Can it go up? Yeah, it can keep going up, but it's a downtrend line resistance. I'm going to tweak that line. Why did I do that? Just to make it fit better right there on, grab that high, and that's where we're at. And again, if whether it does this or not will depend on what the euro and the US dollar does. And here's one additional target if you're going to ride it out and milk out some more gains. So, and again, gold is kind of just a proxy to trade silver and GDX, in my opinion. Like I said, it's just too, it's like trading SPY versus QQQ or IWM, the small caps. You're going to get a lot more bang for your buck in QQQ. But you need to know where SPY, the broad market's going. It's a good measure. And they're going to move in the same direction, the same trend, just one goes up and down more than the other, meaning QQQ, and just like silver and gold. So silver, right off that divergent low, so far up about 12%. See a lot more than gold, but coming up to pretty good. $23 is good resistance on silver. I know that to be a level here on the 60-minute chart. I think I have it on the daily as well. Yeah, you can see right here. Big old gap right there. So there's the top of that gap, reaction high. That's at 23.21. So silver's coming up on pretty good resistance, and then of course GDX. GDX was laid out here off that divergent low, bullish falling wedge breakout. Boom. Minimum target was this downtrend line that's already been hit. I got that out to you when that was hit. That was good for almost an 8% pop. And then I had that next target there, 29.80, and that's what we hit today. So there's a lot of reasons this morning when I get those posts to book profits, at least again as an active trader on the metals, or if you're long, raise stops, because that could be the end of the run. You've got some divergences here too forming on the metals. There's GDX, silver, you have it, see positive divergence. I'm sorry, negative divergence, just like these positive divergences at support where the reason to be long silver right here recently. Okay, I also decided I was planning for a while. The charts are still very constructive on Treasury bonds, but I sold them today. I told you a couple of weeks ago, a week or two ago, I added Treasury bonds starting with the 10-year, and then I layered on the 30-year bond, which we're looking at here, ZB. That's TLT's equivalent, for both a hedge to short positions, index shorts, as well as a pure play based on the technicals. We had a bullish falling wedge breakout, positive divergence, but you can see now we have some negative divergence. And if it's a big if the stock market's going to reverse here at those resistance levels, one of the things that would bring it down fundamentally would be another blip up in rates, because everyone right now is the market's cheering this abatement in rates. Remember, Treasury bond prices, which we're looking at here, move directly inversely to the yields or rates. So this was, along with that rally in the euro, 110% the primary fundamental reason for the stock market bounce, rally, as well as gold and silver. And so that would play in well with a kind of a WTF moment for the bulls right now if we start to see this whole thing crap out. Now again, it looks good. I can tell you there's nothing wrong with it. It's just sort of a hunch trade for me. Normally I would just trail up stops and let it run, but I just decided to book profits, and if it pulls back, I might buy back into these. Even if it goes up, I might buy back into this, because I gave you the long-term outlook where I'll get to that in a second. Yeah, I just want to show you ZN, the 10-year. So this is the other one. Beautiful. That was just a beautiful wedge breakout. And again, percentage terms, it doesn't move up much, but as I said when I originally threw this trade idea out here recently, it's that, in TLT or IEF, the ETFs, you take at least twice what you take in the S&P 500, and even then you take you beta adjust your position size, in other words, to count. So it's been a decent run, and by many accounts it looks like it may have more, but we're getting pretty close. If you want to measure it out, you say that's your target here. There's a primary downtrend line. So I can tell you this right now, I wouldn't short treasuries here. I just again booked profits on it, and I have a little dry powder in case I want to add elsewhere, and again I'll make it back in. Just wanted to share that with you. And then IEF and TLT, for those of you that took those, it's still looking good. It's coming off that big divergent low here, not to downtrend resistance yet. That's an area I may step into short a pullback trade, either there or there. We'll see. Futures will have to confirm. But there's TLT, and you can see also beautiful bullish falling wedge breakout. And again, the reason for this rally, a big part of it, because that's falling rates, falling yields as bond prices went up. But now you have this 60-minute negative divergence. And this would be a kick in the nuts for the stock market if you saw Treasury bonds, especially the 10-year and the 30-year here, go on and bonds make a new low, which means rates bust out to new highs. That's TNX is your 10-year yield. And remember, we're coming off the all-time high. There was every reason to short, recently, the yields, go long bonds. But, and then bigger picture, you still have this primary trend line. If broken, that supports a bullish case for the stock market, unless that would be falling yields, which means bond prices would be going up. And the only reason, I know it's a 180 kind of call, if you see this break and you see this sharp move down, it could also be correlated with a intense pressure, downward pressure in the stock market, a lot of selling, whether you want to call it a crash, impulsive selling, another leg down. You could easily see then, and you probably would see a flight to safety from institutions, pension funds and the likes, dumping stocks and moving money into treasury bonds for a flight to safety bid. But you can also see yields come down based on natural, other forces. I don't want to call them natural, just regular market forces, lower expectation of long-term interest rates. And, right now this is everything to the stock market. So just remember, we tested those previous highs on the 10-year yield, multi-year highs, going back to 2007. Last time rates were this high was back right before the financial crisis started, and the last real bear market started in October of 2007. So that's where we're at. And so the market, I can tell you, stock market has very little tolerance for anything above those recent highs. And again, if I look at this, I can tell you what, I may be long bonds again, because that's a big uptrend line. And if it breaks and you have negative divergence here, and this is a weekly chart, that would send us down. That would be a trend trade to be long bonds if that breaks. And then whether or not it means concurrently to be long or short equities is going to be depending on what the equity market's doing. Does that make sense? So anyway, so right now, I'm just, like I said, this is just a quick profits trade, kind of let the dust settle, and I'll probably re-enter treasuries, and I'll update them. I might update them a little less right now, unless I see something big. Finally, somebody asked about wheat. Wheat is WEAT is a wheat ETN. I didn't even mean to go to the weekly chart, but since I was on a weekly time frame, I'm just going to point out there, that's a beautiful level right there, around $6. Why is that a beautiful level? Well, this was a basing pattern. It was about a 1 year, as tight and well-defined as they get, basing pattern. You had support here as well. So in itself, it was already a support level. Then it became support. Once broken, becomes resistance. And then when you have a basing pattern like that, positive divergence, we were bullish and long wheat back here, it broke out. And that ended a multi-year, decade-plus long bear market in wheat and all other commodities, and was the start of a new bull market. And now we've come back to backtest that from above. We already backtested it once, and I pointed that out, and we hit it and nailed it. This was the 60-minute chart. So back here, we had a divergent low. I gave you 1, 2, 3, 4 price targets. Fourth and final target was hit. At that point, I turned around, made it a short it personally and on the site. We had another divergent low right here, set it up, and then we tested that high again with a divergent high, and that sent it down again. So here we are. We're back to long-term support with positive divergence. This is a wash, rinse, repeat thing. Divergent low, there's your positive divergence, divergent high. All right, no guarantees, but I am now bullish again for the next swing, and possibly, and I think longer term trend trade if this level holds. And the thing is, it's just like the stock market. It's super simple if you really look at it this way. you take a shot at support with a stop somewhat below. This is a weekly chart, so you want to use a weekly close, because if intra-week, it's more than common to overshoot a support level intra-week only to close back above it. So you'd want to have your stops somewhat below it on a weekly closing basis. And if you're a trend trader, then this would be your first target, those previous highs. We've already checked it twice, so I'm betting we'd break on through it. I'll have to modify. These are old levels here. But again, it would probably be the next leg up in the what would be at that point. You have all the makings of a new bull market. There's your low, high, and if we can get up here, and here we are again in the hottest inflationary environment since the 70s. So is it safe to say that wheat just might go up to where it was only back in 2012 here? That's the ETN here only goes back a little bit. Things like wheat and coffee and all these other commodities, which, although the rate of inflation's been, again, highest since the 70s, almost 50 years ago, but yet when you look at where a lot of these commodities are priced at, things such as wheat and corn and all that, they're priced a whole lot cheaper than they were in one of the lowest inflationary environments in decades. Again, back 10, 15 years ago. So keep that in mind. So for those that think, oh well, wheat's not going to go up another 200-300%. If it did, it's just getting back to where it was in a much lower inflationary environment. So I think it's very, very possible. There's corn. Corn's another grain. And corn on the daily chart here. This is a busy board. I have a lot of lines here, but you can see it's been making positive divergence for a while. We had the same thing, a big leg up, which I view as a first leg in a new secular bull market. I view this as a corrective wave with more upside to come. Again, that would be easier viewed on the weekly chart here. Bear market, new bull, initial leg up, a little zigging and zagging correction and something like this. Daily chart, I just showed you, 60-minute chart, just like wheat. And that's what I replied to when somebody asked for an update on it. I said I want to look at the charts of the other grains, which are corn and soybeans. And this is what, this is what swing traders do. You look for these divergent lows, you get long, get a rally, look for divergent highs, get out, get short, wash, rinse, repeat kind of stuff. Okay, in the same comment question that I had for an update on wheat, the member also asked for an update on natural gas, UNG. And here we are. We continue to be in what I view as a likely basing pattern. Why don't I view that as a continuation pattern? It could be. A continuation pattern means, you're going down, you consolidate, and then break down, and the current trend resumes. And there is and was some negative divergence here that I had to point out. I already pointed it was there on the RSI, and I just had to add it. It dropped off on the PPO. But again, it's this T2 level. This was T1, it was hit T2. I have T3, and I may add additional targets. But what I've been saying for a long time, we need to break that level, about $8 on UNG. And what you really want to see it hold, this is where I think a reasonable stop is, somewhat below that 655. Why? Because you have quite a few reactions down there. It was resistance here. So again, we're just in this sideways range, and it'd be bullish to see an upside breakout. Now, what you can also do when you recognize a range, even though it's a little bit of I will say a sloppier range, it's not super well defined on top or bottom, but other than going long on a breakout above it, the recent highs, you can also go long on a pullback to the bottom of the range with a stop below. That's an easy trading style. Watch, rinse, repeat. When you see a price channel or trading range, long at the bottom, and then sell those longs and or reverse, go short at the top, and then do that until it breaks one way or the other, and then you get in for a more of a trend position. 60-minute chart. It's kind of sloppy. We had this bullish falling wedge. Oh, no, back here. We had a divergent low there, hit T1. I must have gave you at that point 4 targets. We hit T2 right there, you can see. So that was, good for off that low there, about 37%. But you can see this. This is why I'm not updating a lot. This is a kind of a sloppy range. Most of the trades have occurred in this band right here, but you have these two spike highs, and that's now the magic number. We take that out, it opens the door to T3 and then T4. You do have some positive divergence on the PPO, but not the RSI. But what you do have is a pretty steep recent coming off oversold readings, just like we had the last time we were this oversold was right here, and you see what happened, that 37% before all said and done from here to here run. So there it is. So bottom line, would I rather be, and I am, I have some natural gas about it for a week or so. Would I rather be long or short right now? Long. Am I crazy aggressively long? No. But I think the RR is up to the upside with a stop below the recent, right around here. On UNG, it's a little below 664 is your support. All right, I'm going to get this one out to you. Keep it right here at the 30-minute mark. And like I said, I'm very eager to see how these levels are resolved, meaning the resistance levels we rallied into today on the markets and Apple, and if they're going to be resolved today. And sometimes they're not. By being resolved, if we park around them, close a little bit above, a little bit below, then well, that just rolls over to the next day. And bottom line is stay flexible. That's it. Don't be married to any one view, because like I said, I can make a pretty decent case for new highs in the market, and I can make a pretty decent case we're not going to see those new highs. And when I can do that, it just tells me, either stay flexible, flip long, short, or keep things light until there's a little more clarity on which way this thing's going to break. All right, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.